In terms of the economy, and certainly the previous panel was giving you some of the very grim things that are on the horizon, it is important to just quickly understand what brought this crisis on so that you can get a perspective on how quickly and rapidly we will pull out of this thing. This was truly a financial crisis. There were no fundamental flaws in the American or global economy that would account for what has happened since the summer of 2007. As many of you know, the financial system, the credit system, is the equivalent of a heart of a body. You can be in great physical shape, you can have a first-rate mind, but if your heart's in trouble, you are in trouble. The same is true with the modern economy. If credit is not reliably flowing, all businesses are eventually going to take a hit. Even if your own balance sheet is in good shape, the balance sheets of your customers may not, and you're going to be dragged into it. That's why when the credit system almost went into cardiac arrest about a little over a year ago, we had that precipitous fall in economic activity in the latter part of last year and the first part of this year. The causes, we love the phrase these days, thanks to the movie and the book, a perfect storm. First part of the perfect storm, one that has not gotten much attention, is the role of the Federal Reserve, which has an enormous impact, obviously, in what's happening to the dollar today. The Federal Reserve and monetary policy and interest rates, there is no more boring subject than monetary policy. That's why I hated to have to speak to you just before the end of a long day. You can see the eyelids getting heavy already. And I'll just give you a travel tip. If any of you ever find yourself in coach, on an airplane, in the middle seat, because of cancellations or whatever, and you're on the runway, watching your life pass away, and you want a little bit of elbow room, talk to your seatmates about monetary policy. You'll have all the room you want. If at a family gathering, there's a particular relative who is boring you, start talking about monetary policy, and that person will never bother you again. But it all boils down to the equivalent of an automobile, truck, whatever it is you drive. You can have a magnificent vehicle, but if you don't have sufficient fuel, you stall. Too much fuel, you flood the engine. Just the right amount, you have a chance to move forward. Same is true of an economy. Economy can have basic strengths, but if the central bank isn't supplying enough money, you'll eventually stall. If it's supplying too much money, you get the economic equivalent of flooding the engine, all sorts of distortions. If they're supplying the right amount, you have a chance to grow. Well, long story short, several years ago, the Federal Reserve miscalculated where the U.S. economy was, thought we were going to be Japan of the 1990s, and turned on the printing press even after the recovery began from the 2000-2001 recession. Printed a lot of money, kept interest rates at artificially low levels. Now, when you do that, print excess money, especially the dollar, you're going to get huge repercussions. First area that money always flows into, when you have an excess amount of it, excess liquidity, is commodities. Usually commodities are all over the place, some up, some down, some treading water. When they're all going in one direction, something is amiss. 2004, you remember, oil went up, copper went up, lumber went up, gold went up, silver went up, soybeans went up, heck, even the price of mud went up, everything was going up. And everyone was wondering, what in the world is going on here? And people are blaming India and China. They're absorbing all the world's resources. If you're a populist, you blame oil company executives, evil folks like that. But it was a classic commodities bubble, such as we had in the 1970s, the last time we engaged in an exercise of that magnitude. But money just doesn't stop with commodities. It also then courses through other parts of the economy. The big recipient, unlike the 70s where oil was the huge recipient, big recipient this time was housing. Housing, as you know, was already booming in 2004, thanks, as you're well aware, to a tax law change made in 1998, when your primary residence was virtually exempted from a capital gains tax, or at least part of it was. If you're a couple, first $500,000 free of capital gains tax. And as you know, when you lower the tax on an asset, the price of it goes up. So if you look at housing prices pre-98, post-1998, you'll notice a sharp difference. So by 2004, housing was already hot in this country, already booming. Then with this flood of money coming in, it went on steroids, just went berserk. New players came in. Everyone figured you cannot lose in housing. It is written in the Constitution. Housing cannot go down. It must go up. And so people figured it doesn't matter for borrower defaults because, after all, the value of the asset keeps going up. So they invented the new mortgage. The new mortgage was, why have an income? Why bother? Why make a down payment? Why pay principal? Why pay interest? They call this stuff negative amortization, and no document loans. And so it was a classic bubble, aided and abetted by Fannie and Freddie, those two government-sponsored enterprises, they call them. End of 2007, guaranteed over $1.5 trillion of suspect paper. Classic bubble finally burst in 2007. But then it was made worse, and this still has fallout on the banking system today, by another huge mistake in another utterly boring area, unless you're in it, accounting. And that is, all right, no jokes, I'm just, but you can tell I'm not running for anything, but romance of accounting, yes. But it gets to banks and life insurance companies. How do you value their regulatory capital? How do you value the reserves they're supposed to hold? You know, banks for future losses, insurance companies for future obligations. Now, traditionally, for regulatory purposes, it was what you paid for it. If you bought a bond, 10-year bond at $1,000, it stayed on your books at $1,000 unless you either sold the thing or it became impaired. Otherwise, for regulatory purposes, it stayed at $1,000. Capital is supposed to be ballast. But why leave something good alone? They brought in what they call mark-to-market accounting, which is fine for mutual funds and the like, but for regulatory capital is and was and has been an utter disaster. Because in effect, it treated like a day trading account. So capital suddenly became pro-cyclical. Markets were good. Institutions had a flood of new capital, which just made the boom even hotter. But in a downturn, it's devastating. At a time when you want institutions to go against the tide, they're getting dragged down with the tide. So in 2007, mark-to-market was brought in. First time we'd done it in this country since 1938. When it was banned in this country because it was seen as one of the contributors to deepening the Great Depression. But bad ideas, like monsters in movies, keep coming back in bad sequels. They just can't keep them in the swamp. They keep coming out of the grave or whatever it is. And so this thing hit. So at a time when you had the financial system taking a real hit, but one, it could have absorbed those hits. There would have been blood on the floor, but it could have absorbed those losses. You could make a case it was no worse than what we had 20 years before. You remember the savings and loans crisis. Almost 1,000 banks went under. Banks were loaded, commercial banks, with Latin American loans, commercial real estate loans. If you'd done mark-to-market 20 years ago, you'd have destroyed most of the major commercial banks in this country. But we didn't make that mistake. So instead of a flood, we got the financial equivalent of a tsunami. Other mistakes were made. And so the system went in virtual cardiac arrest. That's why the TARP money did no good. $300 billion to repair bank balance sheets, but in effect it was immobilized. Now, fortunately, in March, mark-to-market was changed. And it was changed not because of the Fed or the SEC or FASB or the White House or Treasury or any of the usual suspects. It was changed, and I know this was going to shock some of you, because of the U.S. Congress. Yes, the U.S. Congress can occasionally do something right. I know it's a hard concept to get your minds around, but it happened. They were getting pressure on this. They held hearings in early March, announced it in early March, had the hearings, brought in the SEC, brought in FASB, Financial Accounting Standards Board, and just beat their brains out. I mean, if you thought bank CEOs got beat up, these guys were just mincemeat. Not physically, but just verbal, one punch after another. And finally, one of the committeemen said to a fellow from FASB, he said, "You're going to change this in 2 weeks, right?" The guy tried to hedge, consider it, blah, 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 blah. And the congressman said again, "You're going to change it in 2 weeks." And the guy from FASB finally realized, if he's going to get out of there alive, he better agree right away. And so they agreed, and that's when the stock market turned. A couple of weeks later, it was amended, not as much as I would have liked, but it stopped the bleeding. And that's when financial stocks took off. Still far lower than they were 2 years ago, but the bleeding was stopped. The world was not going to come to an end.